Peter, let's kick off with your views on inflation. PPI today coming out at 3.7%. We know that's up from the February number of 3.5%, but it is likely that PPI from here will continue to tick up as a result of base effects. However, the strong rand should prevent it going above 7%. Would you concur with those sentiments?
Yeah, I think that's broadly right. I think of particular interest, though, is the level of imported inflation, which is climbing quite a bit faster than that rate, despite the strong rand. I think that poses some small risk to CPI at this point. Though obviously, one shouldn't read too much across from PPI to CPI. But in general, I think on the business side, inflation pressures shouldn't be too carried away. We obviously, as you said, do have some favourable base effects that they're adding on to PPI at the moment. But overall, I don't think that the market is overly concerned by the PPI numbers.
But it is all about the CPI number yesterday at 5.1%. And again, it's food price deflation that is keeping inflation or CPI somewhat subdued.
Yes, I think the food PPI and CPI, they weren't a whole lot lower than I was expecting, though. I think actually the surprise in CPI, for me at least, was some of the core goods, the more sort of consumer appliances, everyday sort of household goods, that sort of thing, which were a little bit softer than expected. But I think the big elephant in the room that people still aren't discussing really is World Cup inflation pressures that can well come through in the next few months, given the way that Stats SA survey these things. I think one can still perfectly reasonably expect to see inflation back up closer to 7% in perhaps June or July if we do get some very large, for instance, food price and hotel restaurant bills feeding through to CPI at that time. And the SARB certainly, I don't think, are looking for anything like that. I'm not sure the market is too either at the moment.
Well, let's come to Alan Chown on the desk with me. Alan, thanks very much for joining us. So what do you make of that comment from Peter, the big elephant in the room being the World Cup inflation and the impact that potentially could have on CPI?
Yes, definitely. The restaurants and hotels section of the CPI is likely to be the big elephant. We're not quite sure exactly what will happen on that.
Is it going to push us out of the band, in your opinion?
I don't think it'll push us out of the band. We still see a low of about 4.5% in the third quarter of this year, only tracking higher and possibly breaching only at the end of next year at RMB. That's our house view. Other than that, it's still a small component. We're looking at 10% of the basket. We're still driven by lower commodities in terms of corn, and we're still seeing decent disinflationary pressures on
Just
that
your
side
comments
as well.
on PPI, as I said to Peter, coming out at 3.7%, but you don't take much cognizance of this number anymore. Would that be a fair comment?
True. PPI is not as much of a leading indicator for CPI. What Peter mentioned in terms of the import inflation, one could describe a lot of that due to the higher oil price. It's still noteworthy. What is also quite important to take out of PPI is we're seeing the deflationary trend has pretty much stopped now. We are pretty much on even keel at the moment, and ultimately we'll probably see prices start increasing as well.
Peter, back to you in London. If we look at the sovereign risk issue and the impact that is likely to have on emerging markets going forward, the big word is contagion. It's no surprise that, I'm surprised, people are surprised that this contagion is taking place, and we've had the downgrades from the likes of Greece, Portugal, Spain is now in the fold. What do you make of it, and how do you see this crisis unfolding?
Well, I think the downgrades were pretty much to be expected at the end of the day, if you look at the balance sheets and the debt sustainability of these countries and the amount of commitment they've made so far, or lack thereof, to properly rein in their budget deficits into primary surpluses, what they need at the end of the day. And emerging markets are well used to, obviously, this sort of crisis and the need for fiscal consolidation. Otherwise, the wrath of the market comes down to you. But I think policymakers are still very much in a learning mode. I think this sort of bringing the the IMF in and talk of restructuring, all the rest of it is such a cultural shock to people in Brussels and in the ECB as well, that they are taking some time to get used to it. I mean, our baseline is that they get through this year okay, given possibly quite a large package, a shock and awe package as we are expecting, a very large sort of 125, 150 billion euro package for Greece. But the real worry, as you mentioned, is contagion through to other countries. And that's when we really get worried about Eastern Europe in particular, when you start seeing proper contagion into Portugal and Italy in particular. But on the back of all this, I don't think South Africa should be overly affected, either in real economy terms, perhaps slightly in the currency. The rand is obviously exposed given somewhat lower rates at the moment. But on the offsetting point on that is obviously gold. As gold climbs, we can get a slight sentiment impact on in favour of the rand as well.
Just coming to the rand, it's 7.54 yesterday. It was a 2-month low, and today back at 7.34. Volatility is the name of the game with the local unit. I mean, we can't get away from the fact that we do have a volatile currency. But in terms of the rand strength that we're seeing today, as opposed to the relative weakness yesterday, are we just bouncing back? That strength theme just continues to hit home.
We pretty much had a chat to our currency traders before I came through. And we still seem to be in the 30-60 range. They're actually targeting 28. I asked them what are we expecting on the euro. We're looking at 9.68 as the level. They're not really seeing a breakout to the top side. And it seems we're pretty much range bound at the moment, albeit a 30-cent range.
And Peter, your forecasts for the rand, I know Rand Merchant Bank mid-year looking for 7.25 on the dollar rand. They do see it tending weaker towards the end of the year. Can you reiterate your sentiments or remind me of your view on the local unit?
Yeah, we see it remaining broadly flat from here. I think markets have the potential to be buoyed if we do get this shock and awe package out of the IMF and the EU for Greece. But I think the key story still is the end of the year for rand. But in the meantime, the World Cup I think should loom very large in people's minds if they are considering shorting it, and they'll wait till after the World Cup ultimately.
When you say the key story for the rand is the end of the year, do you concur that we're going to see weaker levels, for instance, on the dollar rand at year end?
Yes, we still have our view of 9 at the end of the year that I've often said on here before, and that's, as I always say, is very idiosyncratic around South Africa, politics, fiscal, current account and things like that.
Is it the political factor that's starting to be built in from your side as a risk premium?
Well, I'm definitely surprised by the number of people that are mentioning politics to me, Japanese investors, people in London as well. I think if you like, the index of people's worry around politics in South Africa is certainly a multi-year high at the moment. And it's not so much things like Eugene Terre-Blanche and Julius Malema even, it's more the policy impact that the left can have, which is obviously more interesting for an economist to discuss. But it's quite detailed, I think, the knowledge people want around policy impact on fiscal and growth more generally.
We've got such a wide range of views on where the rand is going. 9 on the dollar rand, is that, in your perspective, Alan, a blowout on the local currency, even if it is over the next couple of months and the momentum is slightly weaker?
Yes, that's definitely a lot more on the bearish side from where we at RMB see it. I think our house view has it at 8 to the dollar at year end. Of course, if you do get past the elephant in the room, past the World Cup, then we're likely to get a bit more certainty in terms of where we're really going. If I know our house view is a lot more bullish than consensus at the moment. However, if the rand does spike out high, it is pretty much the driver of everything. If we're looking at inflation in terms of MPC and where the economy is going, that is essentially where you have to take your direction from.
Peter, I'd like your views on the comments from the South African Reserve Bank governor last week that the market has taken to mean that we're going to see interest rates remaining on hold for some time. Do you again concur with that view that seems to have taken hold in the market?
I think it was very interesting that she made those comments last week, because actually at that time I was just thinking about the probabilities of a cut, and that probably they were larger given the new mandate and possible risks to downside on inflation this week, that sort of thing. So I think it's pretty important that she did make them, and it is certainly an attempt to clear up communication. I think communication has been lacking at some of the recent meetings where, for instance, there seems to be this picking and choosing of exactly what the MPC want to look at in order to justify a rate cut, for instance. But no, still my baseline that they keep rates on hold through to November of this year.